Hey, happy Sunday to you. Hope you're having yourself a great day. I'm Eric, and you're watching Eric's Crypto Corner. I'm a tax accountant with over 17 years' experience in that industry, and I've been in the crypto space for about 5 years, buying, selling, ASIC, GPU, mining some crypto. And also, which one am I forgetting? Oh, CPU mining. There you go. Let's get into today's video. All right, I started my YouTube channel about 3 months ago, and one of the things that I did want to bring up from time to time was kind of tax and tracking crypto and those types of things. So today's video, I had a couple people mention in a couple videos in a row about, man, how do I handle the taxes on this stuff? What's taxable when it comes to mining? What's taxable if I sell my crypto after I mine it? So today I want to talk about a couple different things, how you get taxed when you mine, how you get taxed with your AI earnings, and how you get taxed when you sell the crypto. All right, let's go ahead and get started. Okay, when it comes to mining income or AI rentals income, and we're talking about GPU mining, CPU mining, ASIC mining. I don't care if you're mining Bitcoin, Monero, Ironfish. I don't care what you're mining, Ethereum Classic, or if you're using AI rentals such as Salad, Octaspace, Chlor AI. All this kind of falls underneath the same umbrella where you really need to keep track of your income as to how much you're mining or generating in revenue from AI. And then you can deduct your expenses and you come to a taxable profit here. Okay, so let's just play the game. Let's just say over the course of a year, you mined $1,000 or you did $1,000 of AI rentals on some platform. Any kind of income that you're generating on a daily, weekly, monthly, annual basis has to be recorded as income at ordinary income tax rates. Okay. So when you mine something or you're renting your GPUs out for AI rentals, that is normal income. Doesn't matter when you sell your crypto. It matters that you got it in your wallet. That is typically ordinary income. Now, after that ordinary income, you can write off some expenses, especially if you're running this stuff through a small business. And obviously, most people that are doing this are running this through some kind of a Schedule C. Maybe you've got another business that's set up as an S corporation or partnership that might be big enough that you're including some of these things in there if you're a bigger whale when it comes to mining and those types of things. So you can roll this into similar businesses, similar type businesses if you want. But once you get the income down, it's really just a matter of subtracting your expenses. So internet is obviously a very popular deduction here. So let's just say that's $100 a month. Let's say your general supplies. Maybe you had bought I don't know, just some little supplies here and there. I'm just trying to think of anything in general. Maybe some power cables. Maybe you bought some HDMI cords. Maybe you bought I don't know, like some speakers or something so that you could work on your mining rig. Maybe you just bought some PCIe splitters or something like that. So let's just say that's, I don't know, $50, right? Utilities is another big deduction, especially if you're doing mining. Mining really chews up power. And if you're doing AI, obviously, sometimes you kind of hit and miss with that. You may get a really good job that consumes very low power and a high payout. And other times you have low paying jobs with high power. But let's just say this is another $200 a month. Okay. Now, anytime that you're buying equipment, I typically use the de minimis rule, which basically just means if you're buying a piece of equipment that is under $2,500 assembled, that as a graphics card goes, most graphics cards will fall underneath that amount unless you're buying like a 4090 or 5090 or something like that. But if you're building an entire unit for AI or mining, typically I would call this all one machine. Therefore, we may have some depreciation involved with that. These are just the costs of your build. So you're building these rigs, and let's just say that's another $300. Okay. I'm just using all make up numbers here. These are not real numbers. In fact, you'd probably be losing money, unless your utilities are super cheap. If you're mining or doing AI rentals right now because of the state of the things. But at the end of the day, We then just basically sum all this up and you have a profit of $350. Okay. It's unlikely that anybody's got a major profit this year unless you have free power. Maybe you're doing solar or you're living in some place where you don't have to pay for power. But let's just, for argument's sake, say you have a gain. Okay. Now, most ordinary income in the United States, and I'm not talking about other countries. I'm not dealing with any other countries. So it's just United States. Most ordinary income tax brackets for folks are between 12% and 22%. Sometimes people bleed into the 24 or even a little higher. Oops, let me get this size the same. Right there. Okay. That's normally where people live. Okay, normally. I do about 450 tax returns a year, 100 of which are corporate, 350 of them are personal with normally some kind of small business attached to them or rental or something. So this is normally where people live. Okay. So what we're going to do is we're going to take our 350 and we're basically going to say, okay, well, we made $350 and we're going to multiply it times our 22% tax bracket. In this scenario, you owe $77 in federal income tax. Okay. In the 22% tax bracket, obviously it's much less. You would only owe $42. Okay. So maybe I'll just kind of move this around here so it makes a little more sense. Okay. Now this is federal. If you're lucky enough to live in a state that doesn't have income tax, Florida, Texas, I know there's several others. Then you don't have to worry about state income tax. But in Wisconsin, our state income tax is normally about 5%. We'll just do this, 5%. And so I would owe an extra 5% on that $350. Okay, so if I was a higher income earner, 22%, my total tax on this little mining business would be $95. And if I didn't owe a whole lot, didn't make a ton and I wasn't in a upper middle bracket there, you'd owe about $60. Okay. So this is really just a very basic, how you would set up, your particular business, or small business return here for recording all your income from mining or AI, all your expenses. And this doesn't include everything. You may have other stuff in here. You may have travel if you wanted to go somewhere to pick up some rigs or parts. You may have insurance if you got insurance on your equipment, things like that. There's a whole lot of maybe you use your telephone a little bit, for the business. So whatever. Just make sure it's, legitimate business expenses. Don't be putting in a trip to Alaska or something to go, elk hunting or something in here. But this is the general idea, is that you want to figure your federal income tax, your state income tax, and kind of know where you're at for the income generation part of your mining or AI rentals. Okay. Now, in this scenario, if you were just doing AI rentals like with Salad, and you're getting paid in cash, this is done because Salad pays you in gift cards or PayPal and all this other stuff. But if you're mining and you're turning around immediately the same day when you get, the income in your wallet from mining, whatever crypto you're mining, and you turn around and sell it on Coinbase for cash, then you're pretty much done. Everything is ordinary income tax. This is it. This is how you report it. However, sometimes people don't always do that with their crypto that they held on to. Okay, so sometimes what people do is they'll mine stuff for $1,000 and they have all these expenses, and then they're going to pay this tax on what they've mined, but maybe they've held on to the $1,000 of crypto, right? That they held on to that $1,000, and maybe it's like 6 months or a year, months later or something like that, you decided that you want to sell that asset. So now, yeah, you're paying taxes on what you mined, but now let's just say the crypto moves up to $1,500 after like 6 months or a year. Okay. So this is like originally like mined or whatever, and this is the value at sale. Okay. So you mine this $1,000, and then 6 months later you decided, well, I wanted to hold on to that I wanted to sell it later for even bigger gains. So maybe you're mining something and hodling and hoping that it goes up in value. Well, that's what you have here is you've paid taxes on the $1,000, but now that it's $1,500, you have an increase in value on your crypto. Okay. So really, you're going to pay taxes again. All right. And this is your capital gain. All right. So if you held on to crypto that you mined in 2025 or 2024 or anything earlier, and you've already paid taxes on that $1,000, that's great, through this 350 bucks here. But if the value has gone up and then you decide to sell, now you're going to pay capital gains on the difference. Now, when talking about capital gains, we really have two different flavors. The first flavor is going to be, I'm going to put them both on here. Okay. We're going to have long-term and we're going to have short-term. Now, long-term capital gains is if you held on to this originally mined crypto for over 12 months. Okay, so this is if you held on to that over 12 months. And short-term would really be anything that you held on to for, well, you guessed it, under 12 months. Okay. Now, the easy part is the short term because short term is taxed at the same amount as your ordinary income tax rate. So you can see that if you made $500 in this situation as capital gain, you got to pick which flavor is it, long term or short term. Well, if you sold it for less than 12 months, you held on to that crypto for less than 12 months, it's going to be the same rates as down here. Okay, so you're basically going to say, okay, well, if I'm at the 12%, I made another $500. Thank you very much. You're going to owe another, 60 bucks in capital gains. All right, I can probably move this really over here. And if you're in the 22% tax bracket, well, here we go. Do the math, right? You got 110 bucks. And then don't forget your state. All right, so state should be pretty consistent here. $500. All right, so you can see, well, if I can get this moved over enough. So you can really see here that at the end of the day, you kind of have to pay a lot in the short term. So what most miners will do is they'll say, well, if I'm going to mine and hold, a lot of them will try to hold for over the 12 months. I know a lot of people that have mined crypto and they're just like, you know what, I got to hold on to this for a year because if I make gains on this, I don't want to have to pay the ordinary income tax rate. And why is that? Well, because the long term, when you hold this stuff over 12 months, the rates are significantly smaller. Okay, so you could be at 0. You could be at 15 and you could be at 20. Now, almost nobody's at 20, so I'm just going to leave that out. But then you got your Wisconsin or state income taxes, or sorry, capital gains tax. I'm just going to throw that in there as a bonus. But if you make less than, I believe I just looked it up, and it's like 49,000 as a single filer with all your other income, your W-2 income, if you got other business income. If that's under $49,000, you'll actually pay nothing on your $500 here. So obviously that times this is 0, right? 0. So, and I think Mary joint is like $98,000. So we would prefer to hold on to that crypto for over a year so that your tax goes from, obviously 12%, hopefully down to 0. If you're in the same tax brackets, that's a huge difference, right? And even here, if you're making some good money and you're making $98,000 married filing joint or $49,000 single, then you're only, and more than that, then you're going to be only paying the 15% on this. Okay. So that's not terrible. And then obviously you got your Wisconsin stuff here. Okay. So these are really the flavors of taxes that you have to deal with when we're talking about long-term or capital gains. We got the long-term and we got short-term, and we can obviously see we would rather be in the long-term bucket, right? Excluding Wisconsin. But I'm just saying, I'm not even looking at the Wisconsin numbers. I'm just throwing those up as examples. Just don't forget your state. Okay. But it's much more tax preferred to be in this long-term bucket than the short-term bucket. All right, so in summary of today's video, we talked about the mining income, the AI rental income, how those are taxed at ordinary income rates. If you hold on to your crypto for less than a year and you decide to sell that crypto for a gain, you will pay ordinary income tax on that as well, between the difference of your cost of what you mined it at and your cost basis, and the difference in what you sell it at. Now, if you're lucky enough and if you're smart enough, maybe to hold on to that crypto for over 12 months, then we have that long-term capital gain, which a lot of times you can obviously get at a lower tax bracket if you get lucky, even zero, which is the best tax bracket is zero. Now, there is one other little minor thing that I wanted to bring up, and that is about tax harvesting. Now, if you do have some crypto that's been floating out there for a while, or even this year, even if you've had it for under 12 months and you want to sell it, you think that thing is going to the tank, that is going to zero, feel free to sell it. That's tax harvesting. You can sell it and write those losses off on your taxes. Now, if you do have more than $3,000 worth of tax losses, you can only take $3,000 worth of losses per year. That's kind of the capital gains limit for losses every year. And you can carry those losses over into future years. And that works for Wisconsin as well as I'm sure it does for other states. And now if you decide to use some of those tax losses, maybe you want to sell something that you're up on this year, you can blend those things together. So if you maybe make a gain on some crypto that is $1,000 and you make a loss on crypto that's $500, you will only pay the taxes on the $500 difference. Okay. So blending those gains and losses together, especially at this time of year, because it is getting to be, it's the 16th of November today. And I get a lot of clients this year saying, okay, well, what do I need to sell? What do I need to buy? This is what my taxes are looking like this year. And we have a lot of tax planning going on, for the next 5-6 weeks of the year. Okay. At least I do. So if you've got any questions about that kind of stuff with income on your mining business, or if you've got questions about tax harvesting, capital gains, all that other stuff, feel free to post them in the comments below, okay? All right, well, thanks for stopping by today. Really appreciate you watching the video. If you liked it, feel free to click the like button below or share it with a friend. As usual, this is for informational and educational purposes only. It is not financial advice. Until next time, peace.